Hey there, welcome to the Reinsurance Podcast, the place where we dive into all things reinsurance, the coolest part of insurance. We're your hosts, Jerad and Ben, a couple of ex-practitioners who loved the industry so much we founded Supercede to tackle some of its biggest headaches. And we're here to share our insights and stories with expert guests as we uncover what's really going on in the industry. Welcome everyone to the podcast. Not with me and Ben today, so you're hearing my voice first, but with Tom, Spier. Welcome to the show.
Thank you. No, good to be here.
Yeah.
Standing in for Ben.
Yeah, we need sort of. I can't go solo on these things because otherwise, it's just a monologue, and that's just horrible for everybody involved.
No, the company at Supercede has to listen to your monologue. So
yeah, exactly.
Won't subject the general public to it.
With far worse audio quality as well than the podcast. So it's just a horrible grind, I'm sure. Just listen to my own head every day. Good. But we wanted to spend some time talking about scaling insurance companies, the sort of process by which insurance companies go through that scaling journey, and kind of unpick a variety of categories here. So I'm super excited to dive into this one with you.
Yeah. No.
Where do we want to start? Do we want to start with, because we think about the journey of scale, like insurance companies have been scaling for several hundred years, and the way that looked varies quite significantly, as you might expect, from how insurance companies that are more modern might set up. But maybe perhaps if we look at a company that has sort of a sizable historical growth behind them, and they're trying to continue to grow, but with a brand for several hundred years and the complexities that come with something like that.
Yeah, and that can be difficult, right? We've seen kind of many instances where insurance companies have renewed themselves and tried to create the start of a new era, expanding into different lines of business or acquiring competitors. Over the years, we've seen like reverse takeovers, so Ace taking over Chubb, and then adopting the Chubb brand. Different kind of companies have gone through different stages in very long histories.
Yeah, I think when you look at one of the primary objectives in scaling is like, how do you acquire business? And one channel is to acquire a company and then therefore their business, right? And then looking to use the brand. But more importantly becomes like a distribution channel. And as a direct insurer, that distribution channel is more frequently becoming digital. Right, it's less broker reliant or intermediary reliant than it used to be, and it's how do you sort of figure out ways to connect with and access consumers where they are and how they're shopping, and that's becoming a more important part of how an insurance company thinks about that level of client acquisition.
And there's different models for that around the world, right? So if you look at like the Ace Chubb merger or the takeover by Ace of Chubb. Both of those companies kind of predominantly commercial lines driven, predominantly through agents that aren't tied to a particular brand. And so it was really, really important that they had that singular brand recognition and that they were able to create an identity with brokers who were ultimately their distribution channel. If you look at something else like Direct Line Group was originally formed when the Royal Bank of Scotland purchased Churchill Insurance and Direct Line Insurance at the same time. And they actually intentionally decided to keep those brands separate. In fact, they created 10 or 20 different additional brands. And that's because in the UK motor and household market, which was the majority of their market, most of that distribution was digitally led. And was done on price comparison websites. Yeah. And if somebody was annoyed with a company, they would move to another company. The customers are highly mobile. So the thinking is if you own 20 brands out of the 50 that they're going to see, the chances are even if they do move, they're going to move to you again. And so that was that strategy. So yeah, you see those different distribution strategies really inform big public-facing parts of the company.
Yeah, it's a really interesting angle because what you also see then is in some cases, or an extension of that, different distribution strategies for different products or different brands for different products. A number of companies have their high net worth product or company or division, which is very much you call a person, it's white glove, compared to here is your online comparison website version and how you apply that. So I think you're right. You look at what is the customer segment in the product you're trying to sell, and what's the most impactful way to access the buyers of that specific thing. And that will change not only just that way, but also geographically. How do consumers think about those products in various regions around the world? And that too will inform a bit of that strategy.
Well, and they can intentionally decide not to do that as well, right? Like, if Hiscox decided to launch a budget insurance brand, there is no way that would be called Hiscox, because Hiscox's reputation is around a premium product, always paying out, having the highest or the lowest rate of claim declinature in the market is something that they focus on very, very proactively. So yeah, you can decide not to expand your brand in order to continue organic growth in your core markets.
Yeah, and then one of the other ways you can grow a business is by expanding your offering full stop, right? If you are a monoline carrier, a very easy route to growth is by adding additional products into your suite. And again, that can take a number of forms. It can be a very obvious adjacent product in the same brand. It could be a partnership with an MGA for distribution. It could be any number of ways you'd access a new product, a new geography. What do you see as effective for those sorts of strategies?
Well, there's it depends on risk appetite, right? So the highest risk of those strategies is, you hire a bunch of underwriters and you start trying to write business in a new market segment or a new geography, and then you're all in. It's very difficult to undo that or move. The kind of middle ground way is to use MGAs and MGA capacity to grow that, and of course there are emerging ways which have really only happened over the past couple of years, which is to actually make a strategic investment in kind of a monoline carrier or a startup insurer. And it's those kind of venture moves that are actually quite novel, kind of didn't really happen before about 10 years ago. And that's where we see a lot of movement for now. I think if you're, to probably skip ahead a little bit in terms of what you were planning on talking about, but what we saw a lot in our experience of being in the Lloyd's lab was actually a lot of people come into innovation spaces with a brilliant idea for an insurance product, but no idea how the insurance industry works, or how to get started. And when they describe their initial idea, it's always, we want to start an insurance company. And then somebody comes along and explains just how difficult it is to start an insurance company. And they walk away from that innovation program, the Lloyd's Lab or other similar ones, having heard the word MGA for the first time. And that's kind of the strategy that everybody drives down. Hopefully they can get some kind of growth investment. They can certainly get some backing from industry incumbents. And then they can look to grow from there. Like, they may well become a full stack, fully grown insurance company down the line after that, or they may not.
Well, if we sort of extend that thread out a bit further, it's a really interesting one, because you have this desire to provide an insurance product to the world, but that comes with a lot of risk to you as a business at the easiest level. If I want you to buy car insurance from me, I need to be able to pay for your claims should you have any. The MGA model allows me to sort of back an insurance company to support me on the reinsurance, or support me on the capital in that space. But that same challenge is oftentimes how insurers think about leveraging reinsurance capacity. If you go into a new product or a new sector, a new geography even, you don't have a lot of underwriting experience in that category. You might not have a lot of confidence in your distribution channel strategy yet in that category. And if you make some miscalculations early, that could be the end of the business, because the claims have far outweighed the premium, and that's difficult. And so the partnership can go another level up to getting the reinsurance support to backing those efforts into classes and helping you sort of build up your own performance and giving you.
And you have to be really careful around the narrative of that. As we all know, reinsurance is part science and actuarial work and numbers, and part art of telling a story and creating a version of the numbers that tell the story and the narrative that you want to tell, that's going to secure the capacity that you're looking for. And if you walk into a room with a bunch of reinsurers and say, look guys, we've written all this business, we have no idea what we're doing, then they're not going to be thrilled about that, to say the least. But if you can describe something as a market segment as non-core, and actually you want to reduce your exposure to it over time, but that you're willing to have skin in the game on it, I think that works. Or in fact, like we see it now with MGAs that have grown to a certain size and actually need reinsurance for the first time. So they're transitioning from getting market capacity from primary insurers to getting reinsurance capacity. And they have to set up whole new entities and tell stories in different ways around how they approach underwriting, and how that's novel.
Do you think the way reinsurers evaluate, let's call them net new propositions, based on that narrative, will have changed following like Lemonade's journey? Because I think what Lemonade did, which was really interesting sort of 5 years ago or so, was to create this really interesting narrative around a fundamentally different way to position insurance and position a product. And I think that, and whilst they were still unproven, that story was compelling. And I think reinsurers really bought into this vision of fundamentally changing the perception of our product to the world and to the sort of buying, the consumer audience. That hasn't really panned out in the same way I think they thought it might. And I don't, their numbers are improving, but they've never gotten down to loss ratios like fundamentally better than loss ratios of other insurers or similar. Do you see that having a negative impact for future companies looking to do something net new? Do you see the reinsurers going, this is just how it'll always work? Or not having any impact whatsoever?
I think people will look at that example for sure. But there needs to be an acknowledgement that you're trying to tell a story to two different types of investors depending on what you're looking for. Right? If you're trying to raise capital for an MGA, actually you want to talk a lot about market disruption and what makes your distribution methodology unique, and why your distribution is going to win against existing distribution models. It's all about the distribution. Whereas when you go for reinsurance, you need to tell a slightly different story, which is all about risk control and how do we grow but with sustainable underwriting practices, or is there something involved in our unique approach that actually makes us far better at handling claims or far better at risk selection in some way than incumbent competitors, and that will be attractive to kind of reinsurance markets. So for every story about a Lemonade who's kind of used that investor distribution storyline to reinsurers and have come a little bit unstuck, there's a storyline like Coalition, right? And what Coalition did and what Josh Motta has done there is created a storyline where the technology that they use and their distribution model inherently makes them better at segmenting risk, and it makes them faster at settling claims, which reduces the severity of those claims. And if they can begin to evidence that, even if it doesn't happen straight away, if they can show a trend towards lowering claim severity, for example, then that narrative starts to become very, very attractive to capacity providers and reinsurers. And you can see that the ease at which they can get capacity and reinsurance capacity at Coalition has really fueled their growth in the past 2 or 3 years as they've gone into new geographies. Well,
and you're introducing an interesting thread there around the role technology will play in both how incumbents sort of move into that new world, but also like the pressure that sort of startups or net new insurers will begin to apply to the sector sort of writ large, where a smaller organization that can have a fundamentally better like loss ratio or expense ratio because a huge chunk of their operation runs with very little cost, begins to outperform, begins to pull in other capacity, and they can begin to sort of grow into other places with that sort of foundation set.
You've seen some companies that have started as MGAs with that value proposition of we're completely tech driven, we have no legacy technology to hold us back, and so we can move faster than anybody else. We've seen several examples where those companies have actually morphed into software companies. They make more money by selling that platform that enables better underwriting or better control of claims exposure than they would have made underwriting. Like, let's not forget, as much as we go through, particularly this time of year, and see very, very big numbers in the results of insurance companies in terms of how much profit that they make, proportionately to their income, the profits of insurance companies are very, very small. Proportionately to their income, the profits of software companies are very, very big. So it's, you can see why people have made that move.
Well, you also have it where there's the sort of exit valuation conversation, right? Where it's that ratio of profitability, but also the ease by which you can ramp up your business. And if you're an insurance company and trade at a couple times.
Yeah, 2.5. Too lucky, 2.5. But that, I mean, it's 2.5 book, right? So it's 2.5 income.
Correct.
Yes, there are much bigger multiples than that in software.
But if you're selling software at scale and that is ramping up, you will easily be at 10 or higher, 15, 20, based on sort of growth numbers. So it begins to be kind of an obvious one if you're looking at it. As well as I think one of the other things we're kind of dancing around is the strategy by big incumbent insurers to acquire those smaller insurance companies as a technology play, right? So if you're looking at it as one of these like MGAs with a really impressive tech stack, and one of your exit routes is to have like AXA buy you, but if you start becoming a software distributor to like 25 or 50 or 100 major insurers around the world, your exit strategy looks very, very different and much larger. So it's almost a very obvious direction of travel.
And you can win and you can lose at that play, right? So we've seen both Willis and Aon's technology arms go great guns. They're seen as kind of a trusted supplier of technology solutions to the market. And they kind of rival established insurance software companies that are out there in terms of when people are shopping around, they'll look for solutions from them. And then you'll see things like the acquisition of Relay by a cyber MGA. Like they've ended up having to sunset that product because people were so concerned that this is a software product aimed at distribution, which is owned by one of my competitors. And actually, I'm not interested in doing that. Something we actually see in reinsurance software quite a lot is a lot of the solutions are owned by brokers, and so therefore, people don't want to adopt them. People want something that's independent and agnostic, and doesn't have that market influence.
Well, and it's one of the things that makes the reinsurance space as interesting and nuanced as it is you're exactly right. All the big cedents will work with most of the big brokers, and rightfully so across their worldwide product offering and everything else. So getting software from one of them specifically is that sort of, it's a trap meme, right? with like, they know they don't want to be overly indexed into one of those providers. They know they'd rather have an offering, but it works much more effectively when those brokers sell software to like direct consumer like level or big enterprises, because yes, you might be like Jaguar as an account or something, but like, you're happy to have all of your business go through Aon. Like there's
who's your loyalty to in that situation. I think there's a lot less loyalty in kind of reinsurance broking relationships than some of those primary relationships.
Yeah, I wouldn't classify it as less loyalty, but I would classify it more as like intentional diversification. Like it's almost like there's a very obvious wariness of like over indexing in just one area. You want to like intentionally keep your products or your sort of relationships spread, because because I think the relationships are strong, which is why I don't like the lack of loyalty as the angle. But I think it's the same result of like, no, I need to keep a strong relationship with each of the big brokers for all of myriad reasons. But there's something else that we touched on that we didn't get to sort of fully dive into that's interesting to me, is when you think about how you scale an early stage insurance company or an MGA looking to distribute, there's this point where you evaluate like what's the most cost effective way to launch, to go into a new sector, into a new product. And there's a huge number of ways to do that relatively inexpensively. But by contrast, to set up a net new reinsurer, and you sort of touched on it very briefly, is I will hire 15 people and put them in this office, and I will spend 2 years in hopes that the $10 million we're going to spend will begin to bear fruit. And it's a far, far bigger gamble to set up the reinsurer startup than it is to do the insurer startup.
It's kind of a combination of the things that you've just mentioned, right? There are kind of pull factors in terms of how can we make the most efficient use of capital, how can we grow with kind of the minimum possible amount of inputs, and then the pull factors from that are how can we make sure that this growth is as risk-free as possible, and that is about creating diversification in your portfolio. Reinsurers only exist because they can diversify capital extremely well. Because otherwise there's no other way that you could reinsure against catastrophic weather events, for example, unless you have that diversification. So that kind of risk control becomes a more important factor in terms of how you grow. There's also the way that reinsurers are funded is quite different, right? So sometimes they could be part of a wider group. There's a lot of kind of non-traditional investment that goes into reinsurance companies. And so when they look to scale, they have a responsibility to a different set of investors.
It presents this really, really interesting sort of flow across like risk from the origination sort of point all the way through to the very end stages of capital and like the different business models that are required at each step in that journey. And the very last one that I think is really important as a challenge as you try to scale the insurer is around the sort of regulatory complexity there, right? And I think one of the appeals for setting up a syndicate is you get licenses in all the countries and licenses in all the states, and you get, get
told how to do each annual report return, and
so,
Lloyd's have someone to check it
for
you.
Right. It's like this out of the box model where you can come in with your idea. You still get you have to get approval, and there's more like sort of guardrails, which can be a burden and a frustration for insurers for sure. But the benefits of all of those things can be really quite compelling. And I think this is one of the drivers or the main sort of points behind the syndicate in the box model was building a really compelling framework by which people want to set up that insurance company and see doing that as a syndicate as one of the most obvious ways to get into that business. But if you don't follow the Lloyd's route, you have this sort of, if you're in the US, which is a really painful thing to watch startups do, but it's like the sort of state by state grind as they sort of submit to the local insurance commissioners and all these things. And then if you want to go into new countries, it's like the same again, and new entities you have to set up at every single point in the journey. It's not for the faint of heart.
No, it's difficult. And I've been there trying to launch a wording in the US, and kind of managing a rollout state by state by state is incredibly frustrating. But it's not something that's unique to the US, right? If you need licenses in most different countries around the world that actually have similar populations to a single US state. So if you want to scale more internationally as well, you have the same challenges. And I think Lloyd's is attractive in the sense that you have the ability to catch how many licenses, 100 or so.
Worldwide.
Unique licenses worldwide. So to just be able to leverage that instantly is attractive. I think the other thing about regulation and scaling is just how rapidly regulation changes, particularly when you're talking about 10 or 20 or 30 different countries. And I think that's why we've seen kind of an increase in automated software where companies can keep track of those changes for you and automatically change the way that you report in. I think historically a lot of software that created regulatory reports was built in-house. And the problem with that is that you need to keep up with the rules. Now that we're seeing the advent of software as a service and these SaaS solutions be adopted more, you can kind of outsource a lot of the trouble with that.
It's another reason the MGA model is so appealing, right? You have it where your main capacity provider is great for the UK, but you want to grow in this state. Well, you can get a different capacity provider for that state. And if you go to a different state, you might be able to get a different capacity provider if the first one isn't in that particular state as well. So it gives you sort of increased flexibility of not requiring to sort of grind that all out yourself, but just finding the right partner for where you want to go. So there's still some of that sort of regulatory burden, but it's far less, and you can sort of diversify more rapidly without needing to sort of build the sort of systemic sort of complexity that you have within your business.
In the US, you have fronting providers as well that can provide you with just the paper. Now, that was actually an idea that was established in the reinsurance world, where if you're a non-traditional investment fund and you want to go expose yourself to some reinsurance risk and take some profit from that, you'd find a friendly reinsurer who would give you kind of 100% of the risk on something, and they would write it on their paper. I think in order to help companies grow into particularly niche lines of business, we'll see that happening more and more on the primary insurance side.
Well, and you get that last sort of comparison to the reinsurer setup, where whilst you have a far more heavy go-to-market distribution challenge, you have a far easier access to risk worldwide opportunity, where you set up in Bermuda or something, and you can kind of write reinsurance from any cedent anywhere on the planet, and you get that out of the box, where the insurance levers is a different one. So it's trade-offs in both directions. But again, going back to your earlier point, that's kind of built in. It's in the model. The reinsurers are built around diversification, so that framework works really, really effectively. So it's kind of horses for courses, as they say here. Do you think the American listeners know horses for courses? I don't
know. Is there an equivalent?
We're going to get a bunch of messages about this thing, I bet. This has been a cool one. I want to do another episode later around the sort of reinsurer version of this. Maybe bring in some of the startups who are setting those businesses up and think about how they're wrestling with. Because
I think we should get one in, because all we've basically told you today is there are lots of different ways you can scale, and you need to make some bets, which is kind of pretty obvious entrepreneurial information. So we should find someone who's actually taking the risk for themselves.
We'll set Cordy on the fact of getting us some guests to talk about this in depth. But until then, thank you for listening, everybody.
Thank you.
Thanks for tuning in to the Reinsurance Podcast. If you enjoyed our show, don't forget to subscribe wherever you get your podcasts and leave us a review to let us know how we're doing, preferably 5 stars. For more insights and updates, follow us on LinkedIn and visit our website at supercede.com/podcasts. You'll find the links in the show notes.